Good afternoon, everyone. Glad you could join us. Welcome to Smart Talk, running a startup in a down economy. Today, we are joined by Bob Moore, co-founder and CEO of Crossbeam, a collaborative data platform that helps companies build more valuable partnerships. And Bob joins us today to discuss what it's like to start and run a new company during an economically challenging time. Having started a company, RJMetrics, in the midst of the recession in 2009, then another company, Stitch Data, in 2016, and then most recently Crossbeam in 2018, Bob is well positioned to speak on the trials and tribulations of founding businesses during economic downturns. And he serves as an example that one can still find success during these challenging times. So we really appreciate Bob sharing his stories and lessons learned from these ventures. And he'll be here to answer your questions as well after the presentation. So again, really appreciate him coming on to share his experience and insights. And without further ado, I give you Bob Moore.
Hey everybody, Bob Moore here. Very happy to be here. I have gotten a lot of mileage out of telling the RJMetrics story through a bunch of different lenses, but I think this one is probably maybe the most genuinely valuable and authentic in terms of things that went right and wrong and all the lessons learned along the way. So my goal here is kind of to give a little bit of a narrative timeline between when RJMetrics was started in 2008 through the acquisition of that company, and then the later acquisition of Stitch, which was a spin out from RJMetrics 2 years later, and just try to pepper in a bunch of the lessons learned along the way, specifically as it relates to hard times, and that can be times that are a function of a macroeconomic environment that's not super conducive to a high flying startup, or also just our own mistakes that we made along the way that may have prevented growing a company that was 10 times or 100 times bigger than we ultimately got to at RJ. So I would love it if people hop in with questions along the way. This is not meant to be kind of me talking at you for half an hour or whatever, but I will try to just kind of hit the high points, hopefully keep your attention, and then if you have real-time questions, feel free to just pop off a mute and jump in. And I'll also leave some time at the end if you want to go into pretty much any other areas. But if that sounds good to everybody, I will dive right in. So rewinding the clock, right? I co-founded this company called RJMetrics. I had actually worked at a venture capital firm prior to starting RJMetrics, and at that venture firm, one of the things I realized is just how much better the businesses that use data were doing, especially in that era, which was kind of, late kind of aughts, just before the 2010 era. I just found that there was kind of a new universe of analytics that were coming forward. And the companies that knew how to harness those kinds of analytics were the ones that were just optimizing their businesses faster, making smarter decisions, making better decisions. So we founded RJMetrics, myself and Jake Stein, my co-founder, on this mission of we want to inspire and empower data-driven people. That was the mission statement of the company. And it turned out that building a company in this space ended up being a really special endeavor because not only were there underlying technology changes that constantly reshaped what it meant to have a really good product in this space, but there were also shifting market expectations, which kind of changed who inside of a company was responsible for owning analytics and data analysis, and who was responsible for maintaining those systems. And I think what we got to experience at RJMetrics was just this constantly shifting ground on both the product and the market side that led to a really highly concentrated learning experience over the course of the 8 years or so that we were at it. So, but we had this mantra that we came to the table with, which was basically, we believe that data-driven decisions are better decisions, full stop, period. And if we can kind of just guide what we're building based on that, then anytime we're helping more companies use more data to make more of their decisions, then we are, making the world a better place in our own little way by making people smarter about the way they do things. This is really interesting because when you go to fundraise, one of the things investors absolutely love talking about is this idea of product market fit. And the concept behind product market fit is really, it's one thing to have a product, right? Any of us can build something that does something that we hope to sell to somebody. It's another thing to identify a market, which is a group of people that maybe have a shared pain point or a need that adds up to some opportunity space. But then there's this third kind of like amorphous idea of product market fit, which is almost like the Venn diagram between those two things. Like, is the product that you built actually the thing that's going to create value for the people in this market that you're talking about? Is the market kind of open enough and receptive enough to a product like yours in order to actually be able to capture the value that is there to create? And it's only when your product and your market are actually overlapping with one another, and that's driving usage and behavior of people, and it's actually impacting people. That's when you start to see this product market fit, which is really the core currency of trying to raise a seed round or demonstrate that you have a product that's worth starting to invest in and scale. But I think there was a realization that came from RJMetrics that I'll kind of use as a through line as I tell this story, which is that product market fit is a multi-dimensional optimization problem. And what I mean by that is a lot of people think we built a product and the market's going to shift over time. Like we were early to the market or we were late to the market, and the market's moving around, but our product is what it is. And other people think, the market's there. We're building video conferencing software, so the market is what it is. And the question is, can we build a product that competes, right? We're going to go into the market and we're going to build the right features, or we're going to modify it in the right ways to kind of find a way that the market resonates with it. So you always fix one end or the other and try to make this optimization. And I think that is an oversimplification of what goes on, especially if you're running a company for multiple years in a fast moving industry. Because the reality is that the products move and the markets move, which is what makes it multidimensional. And when you're trying to run this optimization, what you're really doing is not just trying to build something awesome, or not just trying to see where the puck is going in terms of the market needs, but you're really trying to do those two things at the same time, simultaneously. You're looking to pick up on where the trend line is going and then pace your own engineering and building efforts to match up with that trend line so that you're on the same page and you're able to scale with that market. And I'm going to show you at RJMetrics how I think that really was maybe one of the biggest oversights that we had, is that we were always in a process of either trying to change our product to fit the market or trying to change our market to fit the product. And we were playing checkers, not chess, in terms of running this in a multi-dimensional way. So anyway, here's what happened. And maybe the story will be helpful there. So like I said, it's 2008. Jake and I, this is maybe the most embarrassing photo I could find. This is us I lived in Collingswood, New Jersey for a stretch there. We started the company in my attic there. This is us in oversized cargo shorts, as was the trend at the time. And it just in the earliest days of the company. And we had this idea that the best way to deliver these analytics to the companies that we were trying to sell to was to do it all for them and build really what we consider to be full stack business intelligence. And by that, we mean we do these three things. We do what's called ETL, which is short for extract, transform, load, which is basically the process of pulling all the data out of all your systems of record and centralizing it into one spot so that you can actually analyze it side by side. So, get your info about who received an email out of MailChimp, also get your info about who bought what out of Shopify, also get your data about who your sales reps talk to out of Salesforce, pull it out of all those systems and drop it into one spot so that a single query could encompass all those different areas. And that one spot that you dropped it in was a data warehouse. So we had our own data warehousing layer, which is where we would actually physically host and store your data. And then building charts and dashboards and analytics on top of that was a reporting function. And that was really, if you went to our website and looked at what is RJMetrics, what you would see is that front end, the end results you get, the reports that you see. But we had all of this data infrastructure sitting behind it that was really key to our value proposition, because doing this stuff on your own was really, really hard in 2008. You wanted ETL, you had to write your own crazy scripts to extract the data. You wanted data warehousing, you had to spin up. There was very little traction on AWS or the public cloud. So you had to think about spinning up servers and there were a lot of complications and maintenance burdens there. So we kind of were this one-stop shop where you could go buy RJMetrics and solve the problem. So we quit our jobs on a Friday in September 2008. And less than a month later, Lehman Brothers filed for Chapter 11 bankruptcy protection, and the Great Recession started. And these dreams that we had of raising a angel round and going and tackling this problem in a really big way just kind of got vanquished by the macroeconomic environment. It was actually a lot worse than this current environment. Right now, venture capital firms are still writing checks. In fact, in some industries, venture investing has really picked up. Low interest rates have caused a lot of money to pour into private equity, where returns have been stable and good in recent years. So the venture market has cash. In 2008, it was way different. Limited partners who back these venture funds were basically saying to the funds, don't you dare make a capital call. Like, our money is locked up. The financial industry itself was in crisis. And it really, really shut down venture capital for a couple of years there. So anyway, it was rough, right? And we were forced into kind of being a lean startup before it was cool. I think the Lean Startup, the book came out, 2010, maybe 2011. Back in 2008, we kind of had to go master this philosophy of like the build, measure, learn cycle that, if you've read the Lean Startup, all too well. And the real core philosophy in which we ran the business was, we don't make any decisions without data. We need to be profitable because we don't have any capital. And Jake and I didn't have, big padded bank accounts that we could fund things from, which, by the way, contributed to us coming down from New York back into Philly, where we're super glad to have been ever since. Conservative spending, focusing on that. Paul Graham at Y Combinator loves this phrase, do things that don't scale. When you're a startup, you can do founder-led sales, and you can do, little tiny things can move the needle in a big percentage basis because your baseline is so small. And we did a lot of that stuff, a lot of kind of creative PR stunts and founder-led selling and other things. And then really just kind of in a holding pattern, hoping that the market, wakes up and catches up to the product vision, which I think going back to product market fit, I think we were a couple of years ahead of where the market was in terms of readiness to buy stuff like this. But it really didn't work. I mean, we bootstrapped, from that late 2008, early 2009 version of the company. Over the next several years, we got up to, over $1 million in revenue and profitable, and a dozen employees or so with $0 of outside capital. I think we each put a few $1,000 from our savings into the business, and that was it. We really, we did well in this environment where marketing had control over the analytics stack. It was a purchasing decision made by these non-technical buyers, and really cloud data warehouses and infrastructure weren't really ubiquitous. So the idea of buying this like full stack solution was great. People loved it. And we were really humming. And then the market started to wake up again in 2012, and between 2012 and 2014, we raised a seed, an A, and a B for a total of about $23 million, which really felt like a lot of money. But here's what happens when markets start to wake up. People that are smart then start to jump into those markets. And what we saw happen really, really rapidly, if we were the tortoise, there were a bunch of other hares that were kind of waiting in the wings, who really aggressively between that 2012 and 2015 era started putting capital together, where companies like Good Data and Burst and Domo, maybe being the most extreme example, while we were out there feeling great about the 23 million we raised, these companies were raising capital in the hundreds of millions of dollars, and it just created a competitive environment where we were going toe to toe with a large universe of extremely well-funded companies, and it really, really pushed our cost of acquiring customers up. It created a race to the bottom on pricing, and it really just made the economics of running the business we had been running not make sense anymore, because all that bootstrapping mentality and highly profitable practices were getting thrown out the window by companies that were willing to basically take a flamethrower to big piles of money in order to win new business, and we had to compete in that market. And then, kind of like clockwork, innovation struck everybody in that market. And what happened was the new inventions, right? New technology showed up that actually changed what it meant to do this the right way. Amazon Redshift, which is a data warehouse provider, launched as part of Amazon Web Services. And if you remember, we had that data warehouse, right? It's like this piece of our technology that sits right in the middle of our platform, and it's where we store all the data. Turns out Amazon was better at building that stuff than we were. And Amazon Redshift was a product that came along and really just took the world by storm. It made it so that engineering teams and DevOps teams suddenly controlled and owned the data warehouse layer at most companies. It made it part of that ops stack. And because of that, it started to pull control away from marketing teams that might have wanted a siloed solution and put the power in the hands of engineering teams and data science teams that wanted to deconstruct the stack and kind of like compartmentalize things. And what that did was it brought on a bunch of innovation. Amazon Redshift wasn't the only one. Google BigQuery came quickly on its heels to compete with Redshift. Snowflake emerged in this time period. If you're not familiar with Snowflake, they just had the largest IPO in the history of software happen just a couple of weeks ago. They're at a $50 billion plus market cap. All they do is this data warehousing stuff. They're a direct competitor to Amazon Redshift. Big business that got built up here. And it basically like split our stack right down the middle, because now a bunch of people we were trying to sell to already had a data warehouse. So the idea of using an analytics platform like ours that had a second inferior data warehouse in the middle of it that you had to use just seemed redundant and anachronistic. So in the midst of all that, innovation continued to come forward, and a whole host of new companies showed up that were designed to just sit on top of Amazon Redshift or Snowflake or these data warehouses, cut out all of the rest of the stack, and just be really good at data modeling and dashboards. That's where Looker and Periscope, Mode and Chartio, and a bunch of others emerged, and it started to grow at really exponential rates. And then when we went to market and were competing, these were actually the companies we were competing with. All those companies I mentioned before, like Good Data and Burst and Domo, they were all suffering just like RJMetrics because they had the old model. The new model, the tech innovation, actually pulled the rug out from under all of us. And we were seeing our business get lost over and over again to Redshift and Looker as a combination because that's the way the companies kind of wanted to go. So the story that I like to tell around this, getting back to that original theme of product market fit, is that we kind of fell out of product market fit. And this is that multidimensional problem, right? It's like, how innovative you are as a company. If you think about RJMetrics, we kind of spent the first year or two in that bootstrapping mode ahead of the market. We had this really cool idea about doing analytics in the cloud. And, we were slow growing because the market hadn't really woken up to it yet. And during that whole period on the left side of this graph, our orange line was actually ahead of the market. Like we were ahead of where they were in terms of readiness to buy. And then we had this beautiful fit window that kind of happened where we were close enough to be like doing really well and having a bunch of momentum right in the middle there. And that was like 2012 to 2014. We raised all this money, a lot of excitement. And then by 2015 or so, what happened was the market was moving so fast, and we were actually not conditioned as a company to be moving that quickly because we'd spent so much time ahead of the market that thinking about innovation and being the innovative player was just not part of the DNA of our business. We spent all this time waiting for the market to catch up. By the time it was moving so fast that it lapped us before we could even innovate our way into staying on the right trajectory. So because of that, we really fell behind. And if you remember this slide from the beginning, right, this inspire and empower data-driven people, what we found was that in this early era, this statement is so overwhelmingly vague and broad that it really fails as a centralized like vision or mission statement for a business. Okay, inspiring and empowering data-driven people, great. But what does it mean to be a data-driven person? Who are these people? Like, what's our user persona? How exactly are we going to do this inspiring and empowering? What are the metrics that we can measure to actually tell us whether or not we're being successful in this? And by being so intentionally vague and being so reliant on the lean startup stuff early on, I think we ended up being kind of a jack of all trades and a master of none. And what happened is that over time, the industry specialized, and a general purpose solution like ours didn't really have much of a home anymore. And that really, it was like the very thing that kept us alive during the 2008 financial crisis, which was like basically being really scrappy and doing whatever we needed to do for whatever customers we had come in the door, put us in a place where we lacked a centralized vision about where we should be going. And it made us basically not be able to pull some market segment into our world in a way that could, you could build $1 billion company on the backs of. Because you build a company worth tens of millions of dollars or small hundreds of millions of dollars, maybe you could work your way up to it. You could grind it out. But Looker sold last year to Google for $2.6 billion. And that's a whole lot different than selling for tens or hundreds of millions. And the difference is that they had a vision and they fit into a really specific universe that fit into this new model, and they saw it coming. So in falling out of product market fit, we got hit on both sides, because on the left side here, we've got these market dynamics where everybody just has unlimited capital. Tons of capital flowed into the business intelligence and analytics market. Every competitor that we had was better funded than us. Every worthwhile competitor, at least some to the tune of 10x to 100x more capital having been raised. So all of the market dynamics worked against us to kind of squish our total addressable market. And then our product relevance squished it as well. So falling out of product market fit for the reasons that I stated, the shift in the buyer persona, this new tech coming out, also limited the number of companies we could sell to. And then our pricing model and our go-to-market just became totally misaligned. And our addressable market just got smaller and smaller and smaller. And we went from being able to sell our product to almost any company that was out there to really just e-commerce, like mid-market e-commerce companies being our sweet spot. And then mid-market e-commerce started struggling a lot. And we saw a lot of, like, Fab was one of our key marquee customers that was a high-flying, maybe the embodiment of like next generation commerce for a while there, and then it kind of went down in flames. The momentum and power of the case study and everything else that came with it, was dragging us down along with it. So, in 2015, this is where like things went pretty south, and we kept growing as a business. Like, we had a pretty strong year-over-year growth if you just look at the raw numbers. The problem is our targets for growth had just been, to grow multi-100% every single year, even though we had really substantial, multi-million-dollar sales growth goals. The percentage increases never calmed down in terms of expectations. So even though we grew, we just didn't grow enough. And over time, the gap between performance and expectations just widened and widened and widened. And it ended up in early 2016 that we had to cut a good chunk of our sales team, just because the sheer underlying economics of the way the business worked was different than what we had modeled and how we planned to invest that capital. And it just was not, a dollar spent in Q1 of 2015 was not creating the results by Q4 that we had seen in the past. So here's this tactic that I think was like game changing for us, which is we kind of got in like a war room, myself and Jake and some of our execs, and we went through this thought exercise, and we said, look, we understand all these market dynamics, right? And we see why it is that we're getting squeezed here. So let's just ask the question, what would be the worst possible thing that could happen, right? Like, we still have some money. We still have, a pretty big business. We have one that we can optimize toward being pretty close to profitability. Things aren't dire, but we're not participating in this amazing growth that's happening. And we said, what's the product that could get released by somebody else tomorrow that would just squash us, that would take us from like not exciting but okay to not okay? And there was a pretty clear answer, which was, what if somebody released a product that was just the red circle? That all they did was pull data out of all these various services and dropped it right into things like Amazon Redshift. And then it didn't care about whether you used Redshift or Snowflake or whatever. It could drop the data anywhere. And it didn't care about whether you use Looker or Mode or whatever in the front end. Anything could sit on top of that. But this decoupling of this stack, we had seen this huge market emerge in the blue circle and in the green circle. But there really wasn't much innovation in the red circle. And because of that, these data warehouses were still suffering from not having all the data all the time. So we looked at ourselves and we said, oh, wait a minute, we already built that product. That red circle is part of the three-part tower of RJMetrics. And we decided that we would do a little experiment, which is to actually decouple our own platform and start selling just the red circle. And we released this product called RJMetrics Pipeline, with the idea being it's just the data pipelines. It's just the thing that moves data in. And if you want to buy RJMetrics Pipeline and buy Redshift and buy Looker and have that be your killer stack, then so be it. That's fantastic. And we brought that to market, and like it started looking pretty good. And it was small at first, but it looked a heck of a lot better in terms of business fundamentals than the core RJMetrics business. Around the same time, so we had this core RJMetrics business. eBay had spun out this company called Magento, which is a shopping cart provider. We had a ton of Magento customers in the RJMetrics customer base. We were like the de facto analytics solution for people that use the Magento shopping cart. And Magento, when it got spun out, had new private equity owners that started getting aggressive about acquisitions. And they approached us about potentially acquiring our company and technology. And we basically struck a deal with Magento where we got a good kind of base hit outcome where RJMetrics was acquired and folded into Magento, but with the one catch being that we got to keep RJMetrics Pipeline and run it as its own independent company that we still retained. And Magento bought the RJMetrics trademark, so we couldn't call it RJMetrics Pipeline anymore. So we spun it out and branded it as Stitch. And I went in-house at Magento for fulfillment of the earnout as part of the deal. My co-founder, Jake, became the CEO at Stitch. And starting from day one at Stitch, we had all the benefits of this. We could finally play chess, not checkers, right? Because we understood the market we were in better. We had technology and we knew where it fit. We were able to understand and deeply focus on competitive players and competitive analysis. We didn't make these lean startup mistakes where we were accidentally cheap instead of lean. You know, we were efficient about raising and deploying capital, but still able to be aggressive. And it just kind of gave us a fresh, clean start with Stitch. And what ended up happening is Stitch worked, and it worked really well. We launched it in the fall of 2016. And by the spring of 2018, so less than 2 years later, there were more customers on Stitch than there had been on RJMetrics when we sold it. So in 20 months at Stitch, we grew that business to as big as RJMetrics. Took 8 years to get there. And then in the fall of 2018, Talend came along and made us an offer we couldn't refuse, and we sold the business to them for $60 million. The team from Stitch went over and got absorbed into Talend, and I went and started Crossbeam. So now I run this business called Crossbeam. Just really briefly, we're like an escrow service for data, so staying in the data nerd universe, but we help companies identify the intersection between their data and their partners' data or other third parties' data to find things like customer overlaps, sales pipeline overlaps, or other strategic alignment areas, while keeping all the rest of their data private and secure. So it's like an escrow service for data, and empowers all kinds of collaborative sales and go-to-market motions that were impossible before because of security or compliance related restraints. And I could talk about Crossbeam for hours, but I'll spare you that, and I'll hit pause here for any Q&A. But that's the RJMetrics and Stitch story, and hopefully a couple of good lessons embedded along the way.
Excellent. Thanks so much, Bob. It looks like we have Mark has his hand raised. Mark, you can feel free to unmute yourself and ask a question if you have one.
Yeah, great. Thank you. And Bob, thanks for the story. I'm hoping you can talk a little bit more about the kind of the timing and moving your sales organization from the founder-led, into the scale mode, and how that worked and where that fell in the timing with the down economy, kind of the rise and fall.
Yeah, happy to. So our sales it was very interesting at RJ because we had founder-led sales for a while. In fact, if you look at where we were, when we got to 10 people at the company, if you include me, 9 of those people were engineers, and we had one salesperson, which was my co-founder Jake. And I was actually, even though I was CEO there, in the first couple of years of the company, I have a computer science background, and I was spending the vast majority of my time actually contributing code to the core product. So we spent a lot of time on trying to build a product that could be self-serve to a large extent, so that, on a day-to-day basis, we weren't necessarily needing to throw humans at the customer experience in order to make things work. And then also just being extremely scrappy on the marketing side, so that we constantly had this lead generation funnel that was working in our favor, so that basically Jake became a bit of an order taker. And it was only probably when we got to about 12 people that we hired customer success before we hired sales. So our first like go-to-market team members were actually customer success team. We called them analysts, but they were CSMs. And one of our CSMs had a sales background. This guy, Sean McAvinney, who now actually runs, he's the VP of sales over at Leagueside, another local Philly company. And he stayed with RJ all the way through. He ran sales at Stitch, and he was a way back OG CSM turned sales rep at RJMetrics. Love Sean, but he was the first one, and it ended up working out great because he started out doing customer support style work, and he had this tremendous empathy for end customers and also this really deep product knowledge. So when we started, really what was happening was the leads were like falling off of Jake's desk. Like we got to a point where it wasn't outbound sales, it was just handling the inbound sales motions that were coming through. And we brought on, so this would have been 2010, 2011, Sean comes on. We start giving him leads, he starts closing them, and then we look at the economics of what he's doing and we say, oh wow, we should have a lot more of these people. And then we ended up after raising our first venture round, we hired another 1 or 2 salespeople. It was still pretty modest. And then in 2014, we went nuts. And after we raised the Series B, I think our sales team went from 5 people to probably 30 people in about a 12-month time period. And ultimately, a lot of that sales team was SDRs and outbound lead generators. And that was a lot of the team we cut in the layoffs. So I think we waited way too long to staff up on sales. And then we were way too aggressive about trying to play catch up when all these other market forces were unfolding around us. In a little bit more static market, I think that kind of sales headcount growth could have made a lot of sense, but I think we were making these decisions independently of each other, the product market fit decisions and the sales expansion decisions. And I think that was a big mistake because we weren't really planning for a future state. We were planning to just meet what we saw as the targets we had in that moment. So I don't know if that answers your question, and I don't know that it's a model to follow, but that's what happened at that company.
Yeah, thank you. That does. Maybe one follow-up. You
Yeah.
talked about the early growth being primarily inbound, and then the massive growth in your sales team being focused on SDRs and outbound.
Yeah.
Curious as how that fit in. It sounded like the inbound kind of maybe tapered off as you got into the 2014 year, and so you made the shift to outbound. Was that kind of the thinking, or was there something else to it?
Yeah, this is actually a great example of like how it's so easy to fool yourself, because what happened was we had a bunch of reps, at least like a handful of reps, like probably 4 or 5 reps that were all they were account execs handling inbound interest, and that interest we were able to sustain that pretty well. We did a lot of like I had a good relationship with TechCrunch, and I was a guest author there, so I would do these articles that was like, I would scrape a ton of data out of like the hottest, newest startup from the outside looking in, and then analyze that startup using publicly available data in RJMetrics, and then write an article in TechCrunch about it. So it would like showcase all the cool stuff you can do in RJMetrics, but also be about a company people cared about. So we did these articles about Twitter, about Pinterest, about Chat Roulette, about Foursquare, about like name your hot startup, from that era. And we did some kind of takedown piece, analytics piece on it. And those just drove so much traffic to the site. And we did a lot of things that were kind of PR stunty like that. And it helped. The inbound links then generated all this SEO activity. I think we were the number one result for e-commerce analytics, the number one result for like cloud business intelligence for a while. We just had a really, really kicking SEO strategy. So anyway, those engines continued going. Like we kept getting those leads. It's just they were converting at a smaller percentage. So the conversion SDRs, here's what happened. We decided to take one person and have them go experimentally start doing some outbound, and it worked amazingly well. Like the success rate that we saw with that single person going and it just kind of tapping on the shoulders of people out there in the market and saying, hey, not sure if you're aware of our product, but it's this. Do you want to see more? It just like blew everything out of the water in terms of benchmarks that we'd seen around SDR performance. So we said, oh, this is great. Let's hire 20. And I think that the first SDR, maybe the first handful of SDRs, you're tapping into this like pent up demand, the existence of market pull. Like, is it really outbound or is it just like activation of inbound that you've kind of failed to properly service in the past? Like the first people the SDR called was probably people from our newsletter list, which is like people that we have some level of engagement with, but never actually went outbound to try and engage, and they never raised their hand. Sort of, you run out of newsletter leads pretty quick, and then you have to go and start buying data or scraping data or trying to find other ways to get in front of people. And I think the smarter move there would have been, let's go and, actually hire more conservatively, bring on SDRs in a more measured way. But we saw our sales targets, being, oh, this year we need to do 300% of what we did last year. And we have the reps we have. And the SEO stuff is great, but it's kind of like growing linearly, not exponentially. So what do we do? And the only answer was to throw bodies at the problem. When I think in reality, we should have pushed back on our board to have more conservative targets and also thought a whole lot harder about product strategy in the midst of all that.
Thank you.
Sure.
Bob, I had a question for you. So during a time where investors might be, a bit more selective with how they're spending money, are there any key selling points that a startup should be highlighting for investors to make themselves more attractive?
Yeah, the process of deciding what companies to invest in is really just like an exercise in de-risking. So there's a bunch of, especially for early, like we're talking about like early stage, right? Like seed funding. So how do you de-risk a company that doesn't necessarily, totally even know what it is or what it will be yet? And there's a couple different dimensions. Some of them are outside of your control. Experienced founders and founding teams is a huge one. If you look at the companies that are really getting huge access to capital these days, Crossbeam included, you've got a repeat founder at the helm. And what you're inherently doing there is just saying, the fact that this is a founder that's been through the ringer and has spent the last 10 years getting beat up by, bad decisions and volatile markets and, building up that combination of muscle memory and scar tissue. That's something that's inherently de-risking. But obviously that's a thing that's kind of outside of your control. So then the question is, what are the things that are in your control that you can actually influence? One of them is just, there's kind of got to be this great mixture of the rising tide that exists in a market that you're going after, that's just going to increase the chances of you being successful just by the sheer virtue of working in that space. If you are in a universe where your primary customer might be somebody in the travel industry or the events industry in the midst of COVID, you are going, you're swimming upstream. You're fighting an uphill battle. If it's something related to remote work or, asynchronous communication or, collaboration across geographic areas, you're in great shape because you can tell a story about how what you're doing is basically on trend with the macroeconomic direction of the industry that you're in, and that direction is a positive one. So that's what we did at Crossbeam to a very large extent, is we kind of made this argument in fundraising that we're helping people build more valuable partnerships. Where is the historical interaction, collaboration around partnerships happening? It's at trade shows. It's where people are going and they're like, high-fiving each other or sitting at a bar with a beer, pointing at each other's laptops screens, trying to find out where they have shared accounts or collaboration. All of that is going away. And that pulls a lot of the work and collaboration company to company out of these environments where there's traditionally kind of in-person work getting done and into these virtual environments. So, find a way to position the story of your company in the context of this macro environment that is conducive to like a rising tides effect, where even though it is a time of economic uncertainty, it is a bit of a bimodal distribution where there are some industries that are just hit a lot harder and some that are actually doing extremely well, and maybe disproportionately well, because people are being dragged into the future a little faster than they would have otherwise. And it's changing how they consume products and technology. So that's a big one. I think another one is just like the investors love to de-risk on the dimension of business model and economics. And it's really hard at the seed stage. Most seed stage companies don't really have revenue. If they claim they have revenue, it's probably, some kind of hand wavy, like we have pilots signed or a commitment to a pilot, or like whatever it is, the revenue that's coming in at the seed stage, that is not the predictable, sustainable revenue model that's going to be what your revenue is made up of when you're raising, the next round or certainly the round after that. So then how do you get people to have a lot of confidence in this and to de-risk it? My number one answer there is always emphatic customer reference calls. Good investors will do customer reference calls like crazy, especially at the seed stage. They will do them behind your back. They will go and try to hunt down people that have had some experience with your product that are not the ones that are like in your pocket telling your story. So what you can kind of do is like, lead a horse to water in that regard, which is, maybe if you're offering up one or two customer references, in your slides, your presentation, that's great. Make sure you have a slide in there that's got 10 customer logos on it, or, the names of people that are, visible. If it's like a consumer thing, maybe get some consumers that are like visible people that might be very well networked in the community that the investors are in, but don't offer them up as references, but have them ready to get the call, so that you're not putting yourself in a position where back channel references are going to go off script. What you want to have is an investor pick up the phone, talk to 10 people, and have them all tell the same exact story. And that story is, if this product goes away, I'm going to be mad about it. I'm going to be disappointed. You can rip it from my cold dead hands. And that, if you look at the pitch deck for like the Series A for Crossbeam, we've got like this grid of, I think it's 20 companies and a name of somebody at every single company. Like, these are our users. Now, we probably had 100 companies on there, but every single one of those 20 people I went to in advance of sending that deck. And I said, look, you're probably going to get a phone call. I don't know from who, and I don't know when, but here are the things we're trying to reinforce to investors. And I said to them, like, do you think it would be, do you think you're in a position where if you get asked these questions, your answers are going to sound like this? And totally be honest. If not, I totally get it. But this is kind of the narrative we're trying to push here. And 100% of them said yes. And I think it allowed us to kind of spoon feed them a narrative that just made sure that we stack the deck in terms of customer calls. And those, having people in industry that are willing to say this is great and it's worth money, is so much more powerful than a revenue number, because it just speaks to predictability, repeatability, and referenceability of the things that are even more important than the dollars at that point, which is, does the product work? Does it have product market fit? I'll stop there, but those are some of the tactics that we've used around fundraising at Crossbeam.
Excellent. Thanks a lot for that. Looks like we had another question.
Hi, my name is Falcon. Thanks for your talk and advice. I'm actually new to the Philadelphia area, and I'm actually a physician. And the idea for the startup that I have is a little bit outside of my typical wheelhouse, so to speak. And one of the questions or challenges that I'm facing right now is related to product market fit and specifically related to customer discovery. Mm-hmm. You mentioned early in your talk that you had, you were chasing the product market fit a lot in your first company. And I'm trying to understand, can you give us some advice or some insight as to when you say that you had to change, what the product was for the market, et cetera, but what what prompted you to make all those changes, and how did you sort of go about it? Like, did you have to do a lot more customer discovery, or did you really kind of know who your customers were, but you really didn't understand what they wanted? Because it seems like they're two different things sometimes.
Yeah, I think a really common entrepreneurial reflex that happens is a certain level of like, um, it's like a defensiveness or like a protectiveness almost of this precious thing that you've built, or this precious vision that you have. And I think we were probably a little guilty of that at RJMetrics, and it made it easy for us to dismiss isolated pieces of customer feedback, or other things that just maybe should have been picked up on as signal or signs of things to come. And it also made us extremely dismissive of competitors and people that had a different approach to the market. And the idea of like, swallowing the big sweeping change that might represent a real like product directional shift would kind of get kicked to the back burner in favor of these little micro optimizations to make things a little better. So to directly answer your question, listening to not just existing customers, but the people who are not becoming customers. I think if I could go back and do anything a little different, and I am doing it very different this time around at Crossbeam, it is just spend way more time on customer success calls, like check-in calls with existing customers, and sales calls. And I think one thing I did at RJ was, once we hired a sales team and had all these sales reps, I kind of was like, let me get out of your hair. Like, I don't want to interfere with sitting in on these calls or screwing up your script or your flow. Like, we've got this sales machinery over here and it's running, and I'm going to trust that it's running well. And like operationally, I think we had okay leaders in there, and we had good team members, and it ran. But what happened was, there was pattern recognition that could have been done around feedback we were hearing from people that said no, feedback we were hearing from people that said yes, and like really deeply getting at like the postmortem of why we didn't win an account or why we did. And with that absent from my head, I had to kind of like play the game of telephone of like, the rep learned this thing on the call, who then communicated it to their manager, who then communicated it to their VP, who then distilled it up to me. And using information with that many degrees of separation, especially at a startup that, was still, we were, 100 to 150 people. It was small enough that I should have still been able to spend, 20% of my time on these calls in front of customers. And it really took like being slapped in the face by the market in a really harsh way over a long period of time, like the entirety of that year, 2015. When I think in reality, if I'd been in sales calls in January, I probably would have seen the things we needed to see to decouple our stack and launch the Stitch product even sooner, and really kind of drive a turnaround in that fashion with less urgency and less of a cash crunch.
Thank you.
Sure.
Hi, Bob. Just a quick question, and thanks for your presentation. This has been awesome. You talked about towards the end of RJMetrics, you said you had a bunch of interested buyers. I was just curious if you could talk us through the thought process behind, hey, I think I can continue to grow versus maybe now it's time to spin off and focus and turn pipeline into Stitch and ultimately grow that out. I was curious if you could talk us through your thought process a little bit more.
Yeah. So I would say that saying we had a lot of interested parties is probably a little bit of embellishment. I think we had more than one, and it was more than one that got past kind of the conversation stage into like conducting some level of due diligence. So there was like, we could credibly say to Magento, you're not the only one that's looking at this, and we're kind of on a timeline here. We have some process. And there's this phrase our investor used to use, which is like a stalking horse, with the idea being that like, if you have some second party, it's your stalking horse, and you're kind of like hiding behind it as a way to, get really close to somebody else and drive them forward. And I think what we had was a couple of stalking horses and like one realistic buyer, which was Magento. So here's where we were, which was we were in a situation where if things didn't change materially, we were going to be out of cash in less than a year. So we had a couple of options. We kind of had this, in fact, I still have this board deck, because we kind of had like this grid of alternatives. One of them was to go out and try to raise a Series C round. find an investor, get another 20 million bucks into the company, really run at this thing, and continue trying to execute. Another one was to just sell the whole thing, which is like, get it, like, find a buyer like Magento, call it a day. Another one was to do a hard pivot into RJMetrics Pipeline or Stitch. So, basically shut down or wind down the thing that represented 80% of our revenue, but was completely flat and seemed to be declining as a business, so that we could focus on this thing that we thought had a future. And that would require probably laying off, more than 50% of the staff, and like really kind of hitting the reset button, rewinding the clock 3 or 4 years, maybe recapitalizing the business to free up some equity and get a few more dollars in the door. Would have been ugly, but I think, like, in the absence of a buyer, might have actually been the right move. And then there was this like magical other option, which we called like the triple Lindy, which is, hey, can we combine those and actually sell the thing we're thinking about shutting down, get a bunch of cash out, apply some of that cash against funding the new thing that we were going to pivot our way into anyway in the nuclear option. And like the fact that we got that deal done is maybe I've done a lot of wacky stuff in my career, but it might be like the single greatest, like, low probability, like, how could this possibly have been pulled off event, because it's precisely what we did. Like, we manufactured this transaction that basically, if we didn't have that transaction, we would have shut down. This thing that we sold to Magento might have just been shut down. So it was like found money in a way. And it had this amazing added benefit of, like, we didn't have to lay anybody off. Like, people got really good jobs at a really stable company. Magento got acquired by Adobe 2 years after we sold to Magento. And like all the people that went to Magento had like stock options and had like a really killer outcome. It was an amazing story that I think a lot of it was outside of our control and was luck. But so in the moment, right, we had these options on the table. We didn't know that magical option was going to pull through. So in parallel, we were interviewing investment banks who would have potentially represented us on a wholesale sale of the company to like understand like what economics they think we could get. And then we were also pitching a Series C to a bunch of Series C firms to try and get that other venture round happening, and just to collect data points out of the market on what was possible. And a Series C would have been next to impossible just based on the slowing growth rate of the business, without totally like, diluting ourselves into oblivion, or doing a recap. And the investment banks, it did not seem like they were going to bring anything to the table that we couldn't do by managing the process ourselves. And then this Magento conversation just like really, really picked up steam. And one or two other buyers that we had relationships with started getting more serious, and they kind of represented that stalking horse that allowed us to, accelerate the Magento stuff. And it all just kind of came together. But there were a couple of backup plans there. We just happened to get our first choice.
All right. Thank you, Bob. If we don't have any more questions, I just wanted to say thank you for coming on today. Really appreciate you sharing your time and all your insights with us. It's been super illuminating.
Cool. My pleasure. Thanks for having me, and good to see some familiar names in the crowd here, and great to meet everybody else.
Awesome. Before we go, is there anything else you wanted to share with people? Anywhere you want to direct people?
No, I mean, okay, if you're not familiar with Crossbeam, there's a super generous free tier. If you've got partners that you're collaborating with, you ever wanted to know, like, what customers do we have in common, or, are there ways we could kind of sell together out in market? You can go to crossbeam.com, sign up for free, kick the tires, check it out. Always interested in feedback in that area. And sign up for our newsletter, learn about partnership stuff. But I think that's my default plugs, I'd say.
All right, cool. Very good. Thank you again. And thank you everyone for joining us today. Really appreciate it. And we'll see you at the next session.